How is the US reshaping global energy? Why do they need this? And why could it trigger a surge in risky assets like crypto? By the end of this breakdown, you'll understand three key things. Why geopolitical events themselves don't determine market direction. It's determined by how they change the structure of liquidity and capital flows. Why, after periods of stress, does money systematically return to risky assets instead of staying in safe havens? And why, in this specific setup, could Bitcoin be one of the most sensitive beneficiaries of the upcoming global economic cycle? An interesting geopolitical game is currently unfolding where the United States is trying to control global energy logistics, oil production, international supply routes, and essential resource flows. And they're doing this to shift the liquidity balance, economic pressure, and ultimately the direction of capital movement. And this directly impacts the markets. When American and Israeli missiles struck Iran on February 28, 2026, it looked to most like the start of another military conflict. But markets don't react to events in their outward form. They react to the consequences. For markets at a critical juncture like this one, it's not the strike itself that is of the utmost importance, but rather how it fundamentally changes the entire structure of the global system. Who gains ultimate control over energy flows? How trade routes are being reshaped? What happens to global dollar liquidity? And where the next source of growth forms in this new configuration. Because the most significant shifts and movements in risky assets don't happen in a stability phase. They happen once the initial shock has already fully played out and settled. Fear is partially priced in, and the system begins to adapt to the new balance of power. At this exact point, the market stops focusing on capital protection and starts pivoting to find the next source of yield. To understand this, we must go back, not to the day of the strike or even the month before, but to January 2025. The very start of Donald Trump's second term. Because while it later looked like a sudden war, it was actually a very long and detailed multi-stage play. And if you look at it not through the news, but through the eyes of capital, something far more important becomes visible. It wasn't just a military operation, it was an attempt to reboot the world's energy, trade, and financial architecture. By the beginning of 2026, Iran had reached a critical point. Years of negotiations, agreements, sanction regimes, and temporary freezes failed to bring a final halt to its nuclear program. On the contrary, the window for influence was gradually narrowing. At some point, a simple fact became clear to Western countries. If they didn't act now, the cost of such a decision, both militarily and politically, would increase manifold later. An attack on a state that has effectively reached the threshold of nuclear capability is already a fundamentally different level of risk. Consequently, the critical factor of time was becoming key. Any action only made sense before this window of opportunity finally closed. But in parallel, a second, equally important line of development was unfolding. Following the Hamas attacks in 2023, Israel began to gradually move away from the model of limited deterrence and transition to a more systemic approach, the consistent weakening of the threat infrastructure. Over the next 2 years, Iran's external network was significantly undermined. The proxy structures through which it had provoked influence in the region for decades. As a result, by 2026, Iran found itself in a different position. Pressure intensified not only directly, but also along the perimeter. That very buffer system, which for a long time provided strategic depth, began to lose its stability. However, even this was not the deciding factor in the situation. The key constraint had always been the global supply of energy. For many years, any strategic decision to launch a strike against Iran ran into the same systemic risk: the real possibility of destabilizing the Strait of Hormuz. A significant portion of the world's oil supply passes through it, and its blockage would potentially mean a sharp spike in prices. Such a scenario would automatically translate into a global-scale inflationary shock with direct consequences for the world economy, including the United States itself. That is why, historically, the main fear was related not so much to Iran's military response as to the reaction of the energy market. The price per barrel in this equation has always been a key variable. And this is where the real strategy begins. The first step is the internal energy of the United States. Regulatory restrictions are being removed, the issuance of licenses is being accelerated, access to drilling is being simplified, and production growth is being stimulated. It's not just about increasing volumes, but about forming a systemic buffer zone capable or having the capacity to compensate for external steps at the level of global supply. The second direction is Venezuela. And here, the issue goes far beyond the scope of local politics or regime change. The key task is the redistribution of cheap oil flows, in particular, reducing China's access to one of the external sources that for a long time played the role of a valuable stabilizer for it. The third line is the expansion of the South American energy circuit. Brazil, Guyana, and the region as a whole are becoming a source of additional supply that is integrated into the global system and reduces its dependence on individual bottlenecks. Taken together, this creates a critically important effect. Even well before the conflict begins, a supply redundancy buffer is created, which allows the entire system to absorb a major potential shock and greatly reduces the risk of an unpredictable and uncontrolled escalation in energy prices. This is exactly what makes subsequent events not just possible in May, but far more manageable in terms of their broader macroeconomic consequences. That is, while the whole world was arguing whether there would be a war within the system, conditions were already being created under which the war should not have killed the American economy. This is the key point that most people missed. A strike on Iran would have been suicide if an energy foundation had not been laid under it in advance. Now let's look at Iran. It has spent decades building underground bases, missile tunnels, entire cities under the rocks. The logic was clear. If they can't stop us on the surface, we'll survive the first strike underground and retain the ability to respond. And indeed, these complexes made Iran a very inconvenient target. They couldn't just be switched off overnight, but that's the mistake. Iran was building a defense against direct military destruction, but they played a broader game against it. In the modern world, it's not enough to survive a bombardment. You also have to survive the reshaping of energy, logistics, finance, and trade routes. A bunker can save you from missiles, but it can't save the state model if the entire system is being rebuilt around you. When the strikes began, Iran did what everyone expected. It tried to turn Hormuz into a weapon. The logic here is simple. If a huge share of the world's oil passes through this strait, then a blockage will hit everyone. The world got scared, prices will skyrocket, politicians will start pressuring Washington, and the war will have to be wound down. That's what the old scenario looked like. But the new scenario was different. Yes, oil prices surged. Yes, the markets got spooked. Yes, the first impulse was a classic risk-off. Gold, fear, volatility, pressure on high beta. But if you look beyond a single headline, it becomes clear that this shock was not just a threat, but became a tool for reformatting flows. Because the strike on Hormuz hit not only the West, it hit China. Now, looking at China, which relies quite heavily upon Middle Eastern oil, much more than most people would ever care to openly admit. It was China that turned out to be the primary and most significant global player for whom the narrowing of energy flows became, well, a deeply rooted and systemic challenge. This is where the main chess idea is revealed. Venezuela is cutting off one channel of cheap oil for China. Iran and Hormuz are cutting off the second. Consequently, China gets not just significantly more expensive oil, but also the risk of instability in a key supply channel. And America approaches this phase already with increased domestic production and a much more favorable starting position. And this is no longer a story about war in the Middle East. It's a story of energy pressure on the main strategic rival. But now the most important thing for us as market people. Most people make a mistake in the same place. They think that if there is geopolitics, then risky assets are doomed. But the market works in a more complex way. For risky assets, it's not the fact of the conflict itself that matters, but how it ends for liquidity, rates, spreads, and capital expectations. If the war goes into endless escalation, yes, that's bad for everything risky. But if after that initial market shock, the system stabilizes, supply routes are successfully rebuilt, oil prices do not enter into uncontrolled vertical growth, and central banks begin to observe growth weakness and gradually shift towards softer expectations, that is when the most interesting part of the process begins. It is precisely such a two-step scenario that makes the positive outlook for risky assets logical. First fear, then adaptation, then liquidity. So why is all of this important? Because the market doesn't live in a vacuum. If an oil shock and geopolitics don't kill the credit market, if high-yield spreads remain under control, if the banking system doesn't enter a state of stress, if the Fed and the ECB aren't forced to tighten the screws sharply, but instead find a reason to eventually soften their rhetoric as the economy cools, then capital starts looking for yield once again. And where does it look for it? Not in boring assets. It goes where there's asymmetry, technology, artificial intelligence, high beta, Bitcoin, miners, and the infrastructure of a new cycle. That's why geopolitics in such a scenario can ultimately become not a killer, but a catalyst for a new risk-on phase. First, the market shakes out the weak hands. Then a revaluation occurs, and then a new phase begins. The fear has been overcome. Liquidity is returning. Where is the next big growth? And this is where we move on to crypto. Bitcoin in this configuration is already far more than merely a speculative digital asset. It once again becomes a multifaceted bet on several things at once. On the gradual erosion of trust in the old financial architecture, on significantly more accommodative monetary conditions in the future, on a massive new round of global liquidity, and on the comprehensive reactivation of the entire global risk appetite engine. It's no coincidence that the most logical scenario for this model isn't an instant, surge upward, but first geopolitical stress, then stabilization, then a rise in liquidity, and only after that, a real upside for Bitcoin and crypto. That's why the range for Bitcoin in a strong scenario looks logical in the zone of approximately $140,000 to $190,000. And if liquidity and the crypto market enter a full-blown boom mode, an even higher tail is possible. At the same time, it's probably important to understand, this isn't a story where everything looks the same. This will be a very selective cycle. First, money will likely flow into quality, into liquidity, into Bitcoin itself, into large liquid crypto, into infrastructure, into artificial intelligence, and into strong, significant names. And only then, if the cycle truly unfolds completely, will the market start looking more broadly. That is why the fundamental question regarding altcoins is the most critical question that remains exactly the same today. Why do you even need your specific coin? If you cannot clearly explain its value, then in just 1 year's time, you will not be an investor, you will just be a passive passenger in the crowd. The same principle applies to stocks. If financial conditions soften and stay loose, if the AI narrative remains intact and doesn't break, and if credit markets don't enter a period of stress, then long-term assets will perform the best. Tesla, by the way, has a unique opportunity, not just as an automaker, but as a platform at the intersection of AI, robotics, and energy. Meanwhile, miners like CleanSpark offer significant direct leverage to Bitcoin and market liquidity. Infrastructure players like HPE benefit from a new cycle of investment in AI and networks. Banks like Wells Fargo benefit from the system staying intact and the market returning to normalization and growth. And that very geopolitics, which at first seems purely bearish, in a quarter or two could turn into the foundation for a new bull cycle for risky assets. Because big capital doesn't think in terms of, oh, war, everything is lost. Big capital thinks like this. Where will the new profit architecture be after the shock? Who will get control over energy? Where will the next wave of money be? And if the answer to that question is America strengthens its energy sector, China faces pressure on resources. Central banks are gradually transitioning to softer monetary conditions, and tech and crypto once again become the primary beneficiaries of liquidity. Then the market, after the fear, will start buying exactly that. And this is perhaps the most intriguing paradox of the whole story. The world saw missiles, the market saw oil, and politicians saw war. But smart institutional capital saw the potential for future market liquidity. And if this logic is correct, then what looked like the start of a major catastrophe could turn out to be the start of a new growth cycle. Not immediately, not linearly, not without pain. First, there might be shock, volatility, yes, hitting stop losses, and rerouting, a revision of expectations. But it's precisely after such phases that the strongest movements are born. Because when fear is already priced in and a new system is just starting to emerge, risky assets get what they need most. A new story, new liquidity, and a new reason for an upward revaluation. And then the main question is no longer whether this game was tough. The real question is something else. Did you even notice that the board has already been moved? And that's all from me. Don't forget to leave a like and be sure to subscribe so you don't miss the hottest news.